Hello everyone, I am Sabir Ahmed, the accounting tutor, and I welcome you to the first lecture of IGCSE Accounting. This lecture is all about the basics of accounting, and to get started today, we will learn about journal entries. By the end of this lecture, you would have detailed knowledge about the basic accounting equation, definition of asset, liability, and equity, concept of debit and credit, and you will also be able to journalize transactions. Let's start with the basic accounting equation, which is also called the golden formula. As you can see, the equation states that the value of the assets of a business must be equal to the sum of the values of equity and liabilities of the business. But before we discuss about this equation, we must have a clear knowledge about the terms asset, equity, and liabilities. Assets are resources that a business has ownership of and that helps the business to generate revenue. In accounting, assets are generally classified into non-current assets and current assets. Non-current assets are generally purchased in order to be used in the business, and they usually last for more than just a year. For example, premises, equipment, motor vehicle, and machinery. All of these assets are not usually sold in a business but utilized for different purposes that enable the business to run its operations efficiently. On the other hand, current assets refer to those assets that are usually used up within a year. This include inventory, trade receivables, bank, and cash. Inventory refers to the unsold stock of the business that it plans to sell in the near future. Trade receivable, however, refers to the credit customers who owe the business money, such as those who have bought the goods from the business but promised to pay for them within a month or two. Bank refers to the cash stored in the bank account of the business, and cash refers to the money readily available in hand. Equity is simply the investment made by owners or founders of the business in order to make the business operations run. Equity is also known as capital. Moving on to liabilities. Liabilities are simply borrowings taken by the business that it has to repay in the future. Just like assets, liabilities can also be classified into non-current liabilities and current liabilities. Non-current liabilities are those liabilities that give you more than a year to repay. For example, a bank loan. A bank loan usually allows a repayment period of at least 5 to 10 years. However, current liabilities are due only within a year. This includes trade payable, bank overdraft, etc. Trade payable refers to suppliers from whom the business had purchased inventory in the past on credit and who need to be repaid within a few months. However, bank overdraft is a situation that occurs when the business withdraws more money from the bank than its actual balance. For example, let's say the bank has $10,000 stored for the business and the business withdraws 12,000. So the business has actually withdrawn 2,000 extra, which it needs to repay to the bank. Hence, it will be treated as a current liability as the bank will not allow more than a financial year to repay the overdraft. So we have now learned all about the basic accounting equation, which states that all the assets of a business must be equal to the summation of the equity and liabilities of that particular business. This is the exact same equation that is also used in preparing statement of financial position, which we will learn in one of our upcoming lectures.